Advice on wealth management firms. 5 things to double check before choosing one. No wealth management firm resembles the next one, whether it is on fees, clientele, investment vision, or asset allocation. Each firm brings its unique mix of expertise and performance into the investment equation. Before choosing a manager, a wealth manager that is, to help you preserve or grow your hard-earned money, check out these 5 tips. Welcome back, folks, to another edition of Sweetie Kiwi, the Sweetie Kiwi Show. We bring you all the content of the world, the best content of the world, and I hope you are doing fantastic. I'm doing marvelous. If you are doing as marvelous as I am, go grab a cup of coffee or tea or vodka and let's roll. Today, I want to give you 5 things you need to double check before choosing a wealth management firm. Now, number 1, take a look at the company's track record. You have to understand that, a wealth manager typically has millions, hundreds of millions, or even billions of dollars in asset under management, right? But that alone is not an indicator of how well they serve their clients, right? So you want to, let's say you've selected a few, you narrow down your list to 5 or 10 firms, right? You want to consider the past history. Even though they always say past performance is not indicative of future performance, you want to look at the past. The past will tell you a lot about someone or a company, right? So you want to think about things like, have they received any kind of special recognition, any kind of awards? Have they been cited in the news media? Have one of their star managers appeared on CNBC or been cited in the Wall Street Journal or Bloomberg? You want to look at their past record. Now, it's very important as you look at the good side of things. You also want to take a look at the bad side of things. Have they been cited? Have they gotten any positive reviews or negative reviews through the Better Business Bureau or another consumer sites, right? Check their Google ratings, their Google reviews. Think about the SEC or other regulators like FINRA. Have they received any kind of negative or disciplinary action against them? This is very important because digging into a firm's background might be a little convoluted. It might take some time. It can be costly also, but believe me, it is worth the time, energy, and resources. If your goal is to build wealth in your 20s or 30s or before retirement age, you want to invest that time and money to find out. Now, one thing you have to understand is that performance results usually, when it comes to wealth management firms, they are shown net of fees and they reflect the reinvestment of dividends and capital gains, right? So you want to basically understand what is part of the fees. What are the fees, right? So you want to look at the advisory fees, the AUM fees, the asset under management fees. This is very important. Now, by looking at that, you can also pay attention to something that is indicative of this particular wealth management firm you're considering hiring. For instance, their investment strategies, right? Their investment vision. You want to look at how long they're able to hold a holding. What is their overall vision? What their overall mission, right? Because wealth management does not include only investment management. It also includes things like estate planning, tax planning, right? Education planning, charitable giving, all these things, because they look at what they call legacy, longevity. They look at something called liquidity. So it's an all-in-one package that you got to pay attention to. Now, you have to remember the reason why you have to do this is because different types of investments involve varying degrees of risk, and you cannot be assured that any specific investment will either be suitable or profitable for your portfolio, right? So this is very important. In addition to that, you have exogenous factors, right? Because investment strategies are endogenous to the wealth management firm you want to choose, but you have exogenous factors such as economic factors, market conditions, the regulators, regulatory changes. All of these things can influence the impact of your wealth management company. So as you're taking a look at the company's track record, make sure that you contextualize that review. You're able to analyze their performance against a whole set of variables, throughout the period under review, right? So it's not just you looking at the performance, the ROI, what they have, what ROI they have produced for their clients, but consider the ROI based on the backdrop of regulation, the backdrop of economic growth, the backdrop of competitive fierceness in the industry. All these things will give you a high degree of understanding and a high degree of confidence when it comes to choosing one wealth manager over another. All right, I'll be right back right after this. Don't go anywhere. Welcome back, folks, to another edition of Sweetie Kiwi. I'm very happy that you're still here with us. Really appreciate it. If you love the content's clarity and quality so far, please consider subscribing to this channel and turn on the notification bell so you are aware whenever we drop a new show. Comment below, share, and like if you like. Now, element number 2. So element number 1, take a look at the company's track record. Element number 2, compare what the firm is selling. It's very important, folks. So if you're looking for a wealth manager, you probably already have a clear idea of, why you need them, right? You have a vision, you're trying to grow your wealth, or you're trying to preserve your wealth, right? But you want to specifically pay attention to the kinds of products and services the firm offers, right? So, for instance, if your wealth manager only offers investing advice, well, that could be good for you if that's what you want. Or if they only offer taxes or estate planning, that could be good. Or if they offer a combo of those things, then so you have to pay attention to that. So you have to pay attention to, as I said earlier, when it comes to wealth management, there are 3 important things. You have liquidity, you have longevity, and then you have legacy. So in liquidity, you talk about cash, you're talking about investments, asset allocation, right? When it comes to longevity, you're thinking about retirement, the ability to be financially sound in your golden years, the ability to be properly insured, life insurance, and all those other types of fixed sources of income, such as bond interest and annuities, and then when it comes to legacy, you want to think about philanthropy. You want to think about life insurance. After you pass away, how will your beneficiaries actually live? Which communities would you impact? This is very important. So you want to pay attention to the wealth management firm overall investment strategy to make sure it aligns with your goals, right? This is very important. Now let's also talk about let's talk about some of the investments that are usually present when it comes to a wealth management investment strategy. So you have, for instance, there are some wealth managers that do automated trading for you. They invest your assets automatically. So those usually don't have any minimum investments. There are no annual trading fees. The average fund expense ratio is kind of low. The internal fund trading cost is also low. They don't have fees for management, and of course they have a cost per year that will depend, but you have to find that out when you talk to your advisor. Now you also have something called the DIY ETFs. So basically, these are wealth managers that allow you to set your own strategy, to implement your own strategy. So DIY, so ETF stands for exchange traded funds. So you're able to set things, but the minimum investment, there's none. But you have annual trading fees. They're kind of low. You have, of course, an average fund expense ratio. You have internal fund trading cost that varies. There are no management fees, but of course there is a cost per year. And then you have the mutual funds, right? So basically you have mutual funds such as Fidelity, Vanguard, you have Schwab, Charles Schwab, State Street, T. Rowe Price, and many more. There, of course, there is no minimum investment. They want you to get in with no minimum investment. You have no annual trading fees. The average fund expense ratio is a little high because it's based on your asset. The internal fund trading cost is also high. There are no management fees, but the cost per year is kind of high. And then you have the traditional manager, the traditional wealth manager, right? Those here I'm talking about manually managed portfolio. And because you need an actual wealth manager, you actually get to have a minimum investment. Usually it's 100K, 100,000, and there are no annual trading fees, or there are, but they are kind of they vary. The average fund expense ratio is kind of high. The internal fund trading cost also varies, and the management fees is high, and the cost per year is also high. So the more money you have, the more money they want you to put in as a minimum investment, the more cost you have, because they have to cover all those people, actually, the front office, the back office, all those people that help manage your money. So it kind of makes sense. I'll be right back right after this. Don't go anywhere. Welcome back, folks, to another edition of Sweaty Kiwi. We're still continuing our conversation here with the 5 things to double check before choosing one when it comes to a wealth management firm, right? So in number 1, I told you, take a look at the company's track record. Number 2, compare what the firm is selling. Number 3, figure out who the firm's ideal client is. This is very important. Before you sign up with the firm, you want to make sure that you are their ideal client, right? You want to identify whether or not this is something that you basically can benefit from them. This is very important, right? So you usually wealth managers want to differentiate their clients in 4 categories. So result oriented, clients who value relationships with trusted advisors, clients who have a love of family, and clients who are involved in the community. So you want to basically make sure, again, that you fit their client base, their ideal client base. And this can be not only seen in terms of common traits, you can also see it in terms of minimum investments, right? So for instance, some wealth managers will want you to fork over minimum 100 grand before they even consider you as a client. So whereas some other wealth managers exclusively target millionaires and billionaires. So you got to really do the math and be comfortable with the fact that they are your ideal wealth manager or they're not. All right. So you want to basically check. You also want to check out what kind of services they offer. All right. Now we talked also about number 4. You want to check out the pricing, right? I mean, because a wealth manager generally will help you increase your wealth. That's what they are paid for. But the thing is, they're paid. They don't work for free. So a wealth manager typically gets paid by charging commissions on the products he or she sells, or assigns fees to specific services, right? So the thing you want to do here is that it's better to get a fee-only advisor if you don't want to be bombarded by a sales pitch every time you meet with your wealth manager, right? So that's very important, because if your wealth manager is getting paid on the products they sell to you, you'll be bombarded every time you meet with him or her. Okay. Now, another thing you want to think about is when it comes to cost, one of the most important things to consider is the amount of value you'll get for what you pay, right? It's all about, is this a value adding element or not, right? It doesn't matter if a service is very expensive, but the bottom line is you got to ask yourself, am I benefiting from this service, right? So if, for instance, you're paying a large percentage of your earnings on fees, is a good idea, for instance, to be certain that your portfolio's performance is worth the added expense, right? This is very important. Now, you have to understand that basically asset management fees work differently. For instance, if you're a client with a $1 million under management, typically you might have to pay around 1% of your asset per year. Okay, and this is according to a recent Wall Street Journal article. And you have some companies that charge fixed annual fees, right? So and believe it or not, some other companies in the industry, even though they are in the minority, they charge hourly rates for their services. So the more help you need, the more you'll pay. But if you have relatively simple needs, then this way of working can save you tons of money, right? And also, and that's the fourth category, according to the Wall Street Journal article, you might find several companies that combine aspects of this model. So I'm talking about the fixed fee, the hourly rates, the fixed annual fees, and so on and so forth. Now, the thing here is you have to understand is that at the end of the day, you want to make sure that the service that are provided match the cost. In other words, you are extracting value, you are gaining value from the expenses that you are incurring, right? So it's up to you to choose the right fee strategy that works for you. As a matter of fact, you can even ask every advisor that pitches to you, every wealth manager who pitches to you, you can ask them this hypothetical question. Give them, for instance, let's say you can say like, if I were to invest $1 million with you, $1 million with you, how much will my cost be in the first year? Just ask them that hypothetical question. And then what you want to do is you want to ferret out all the questions and ferret out what really drives them, and try to ask as many wealth managers as possible and compare and contrast the results. All right, I'll be right back right after this. Don't go anywhere. Welcome back, folks, to another edition of Sweaty Kiwi. We're still continuing our conversation today around 5 things to double check before choosing a wealth management firm. And I've given you 4 so far, and this is the last one. You want to ask about your wealth manager's availability. This is very important. You want to, because when it comes to wealth management, their basic roles is this: they need to help you design, build, and protect your wealth. They need to help you grow the wealth. They need to understand and clarify your life and financial goals. They need to use academic research and financial science to build an investment portfolio that gives you the highest probability of achieving your goals with the least amount of risk, right? This is basically it. And when it comes to protecting, they have to provide the discipline, the perspective, and guidance to help you stay focused on the long run and on track towards achieving what's most important for you, right? So, to do all of these things, they've got to be available. The last thing you want to do is play phone tag with your wealth manager, right? I mean, if they're so important, if they're so busy to handle, to take your phone calls, you bet they're not available to manage your portfolio either. So it has, wealth management is an industry where face-to-face, close connections, tight-knit connections are as important as ever. If you're a millionaire or a multimillionaire or a billionaire, you want to make sure that your manager is available to talk to you, is available to handle your business. If not, then move on to the next manager. All right. So this is it, folks. This is we're about to wrap up today's show here, and I really appreciate you listening so far. And here is a recap. The 5 things to double check before choosing a wealth management firm are: number 1, take a look at the company's track record. Compare what the firm is selling. Figure out who the firm's ideal client is. Check out the pricing. Ask about your wealth manager's availability, right? It's very important. And in terms of pro tip, I like to give a pro tip at the end of every show, some kind of extra advice. The bottom line here is that working with a wealth manager is more about forming a relationship with someone who has a fiduciary duty to you and cares about your money as much as you do, and less about just putting your money elsewhere and hope that it will grow. No, it's about relationship cultivation. You want to cultivate a relationship. Otherwise, you might as well just do things yourself, or just get into one of those things called robo advisors. They'll just get it done for you. So you want to choose the right person, because choosing the wrong one has the potential to be disastrous, not only for you, but for the next generation if you're planning to pass wealth onto your heirs. Right? It's very important. So, spend time to find out the best financial advisor or wealth manager. Make sure they have the right qualifications. If they have to sell securities to you, make sure they have the right FINRA securities licenses. It's very important. I'm talking, Series 7, Series 6, 67, 63, 79, all that kinds of stuff. As a matter of fact, we just did a show on that, on the FINRA securities licenses. You might want to check that to learn more about that topic. All right. Thanks for listening until now. Really appreciate it. And I'll see you next time. But until then, stay marvelous.